Look, it's wonderful to be with you. I think this is a very topical subject. We've got the new possible era in venture capital. We've got a wonderful panel to discuss some of these issues, and I thought we could just spend a few minutes on the general picture at the moment and then drill down into some of the opportunities that we see. So, Andrew, could I first start with you? I'm going to play a little bit devil's advocate. There was an article recently in the Wall Street Journal that wasn't terribly positive about the future for venture capital within the next year, 18 months or so. I know you think differantly, or there's certainly some. Could you comment on perhaps that situation and perhaps tell us a little bit first about what you're doing? Yeah, Andrew, at Antler. Edward, sorry. It's okay.
I don't really have a strong view on what's going to happen in the next 18 months. I think that's very difficult to foresee. I think maybe we can start with a couple of, well, just two observable truths, because I think opinion is cheap. We know that the millennial generation, so anybody between the age of 25 and 40, are graduating in record numbers with record levels of student debt into real estate markets in any major city in the world that are 5 times the price that they were 25 years ago. All fact. So unsurprisingly, that's driving super different behavioral decisions and choices, not only at the age at which people decide to start having families, which has its own implications for aging populations, as we're seeing in Japan and some parts of Europe, but also in their career choice. So up to 30% of US university graduates now say that the #1 career choice is to be in innovation, because guess what? Finance and law, which have traditionally held the monopoly on talent, don't represent the same wealth creation opportunity as they did 25 years ago. So you're looking at the mass migration of the world's brightest and most ambitious people who are increasingly building and innovating. Those are the numbers. That's what we can see. That's what we know. Secondly is that cloud computing has only really been with us for 10 years. So we're just at the very beginning of understanding that businesses can now be built anywhere in the world for minimal upfront cost with the ability to reach vast audiences. So let's stop there. I mean, those two observable truths, they're not opinion, they're fact. And I would think that if you're looking at the mass migration of human capital turbocharged by technology, that's probably worth paying attention to. I don't have a view in the next 18 months, but I'm pretty sure you want to get behind that in some way on a 5, 10, 15-year view.
Thank you very much. Zaid, could I turn to you now? Could you tell us a little bit about the work you're doing at Patrimium, and also how you feel you see the scene at the moment after the boom years we've been through?
Absolutely. Thank you, David. Patrimium is a new multifamily office that I'm in the middle of setting up. I've been with the Chimera for the last 6 years, which will come with Patrimium, and we've been investing actively in all asset classes, including venture capital, across the world through funds and directly through companies. So yeah, we have seen the massive increase in valuations over the last few years. We have tried to maintain a disciplined approach throughout, not following the hype. For example, and against the theme of the whole day, we have not invested anything in crypto in the last few years. We've tried several times, but we just couldn't underwrite things. And when we can't underwrite something, even if we get it right or wrong in the future, we can't justify going in. Blockchain, on the other hand, is something we are very interested in, and when we find proper use cases, we would invest in. So having avoided all the overhyped and overvalued opportunities that came our way, we've had very little write-downs in terms of valuation markdowns. Of course, we've seen losses and companies go to zero. That happens with any proper investment program in the VC space. In terms of your comment about the next 18 months, well, yes, they will be difficult, but surely, and yes, it's an opinion, but also based on logic, it's a great time to invest. Probably the best time, one of the best times to invest in recent years will be in 23 and 24. And you should see some great returns from these vintages if you get your selections right.
So we'll pick up on that in a moment if we can. Samantha, could I turn to you at RockawayX? I think you've got a very interesting specialization, if I can put it that way, expansion of Web3. Could you talk a little bit about that? And again, where you see the main opportunities within your area of operation?
I'm not sure if this is working. Yes, it is. Yeah, so we are an investor and operator in the digital asset space. And what that means, on the one side, we have a venture fund, we have a crypto credit fund, and then on the other hand, we have an infrastructure business, so that runs validators on blockchain networks. It does that in service of our investments, but also for other funds, other custodians, other clients. We have a security business, and then we have a venture studio, and we're in the process of acquiring a crypto market maker. So what's interesting about that model is that it lets us sort of make a thesis and then express that bet in different ways. So we can do it by making an investment in a company, whether that's taking a really active position or being more of a passive bystander, or we can decide to incubate something in-house if we think there's a big gap in the infrastructure stack or an opportunity that we're uniquely well positioned to develop.
Thank you, thank you. Edward, if I could turn to you at this point. If you again read some of the commentaries on where venture capital is at the moment, a number of commentators, including Peter Thiel, who's not very much in favor at the moment, I know, has said that, look, there was a golden age of venture capital. And just to quote him, the industry has ceased to be a funder of the future, and instead has become a funder of features, widgets, and other irrelevancies. Now, could you comment on that and let us know where you feel the growth, if you can identify a sector for that, or one or two sectors, is going to come from?
I guess it's for all of the audience to debate, but it seems to me that AI, there are 6 or 7 key technologies: AI, genomics, blockchain, robotics, quantum, synthetic biology, that are fundamentally affecting every single sector, or foundational sector in the economy that we know. So if you think about the way that we feed ourselves, can it be right to rear and slaughter 80 billion animals to feed 8 billion people? That doesn't feel logical. The way we feed ourselves, the way we transport ourselves, the way we educate ourselves, the way we finance ourselves, the way we power ourselves, are all built around frameworks and architectures that are 70, 80 years old. It's probably time to update than you would think. And so I don't really see any aspect of the economy at all that isn't affected by these innovations. And the reality is you can't stop people from coding. And you can't take the password that's in your head. It's out there. And so you get these news flow items that whip us around, which whips the sentiment on these things. But let me put it to you another way, which is if you own shares in Glaxo or Pfizer, and the CEO said to you, I'm going to cut my R&D budget to 0, I think the first question you'd ask would be, okay, so where's your pipeline? Where's your growth? It's the same thing for a country, which is if you look at most developed economies which are dynamic, R&D as a percentage of GDP is 3 or 4%. Venture and innovation is the GDP, is the R&D of a country, and so these changes are pretty overwhelmingly clear and pretty overwhelmingly obvious, and there's going to be Kodak moments all over the place. So invest in this stuff, don't invest in this stuff, but at the very, very least, you need to understand what it means for your existing legacy exposures in your portfolio of credit or equity or other investments you may have. But I think everything's going to be affected. We're all going to be invested in venture capital to some degree. Right.
I think the nostalgia was for the Intel period, the golden age, and it's gone. Yeah, thank you. Zaid, could I pick up on a point that we've discussed already, that perhaps you're looking more at slightly later stage companies? I mean, you want to see a track record and some sort of management, rather than just investing in, some incredible future situation. Is that a trend?
No, not necessarily. I mean, we invest from anything from seed stage to right up to listed in the growth. I see in the market today, obviously, if you look at it 18 months ago, everyone was looking at growth, getting excited to pile into growth companies that are going to list and multiples are going to jump. Now, fast forward, everyone wants to go into the early stage because they know the exits and the IPO market is not going to be open for quite a while yet. But we just look for the same thing across the board. We look for, back to your earlier statement of, we're building plenty of widgets and things that we don't really need. Probably true, but also what Edward said is true in terms of, yes, technology valuations have collapsed, but technology remains a fundamental part of our lives and economy and society, and it's not going away. And the importance of it is will be emphasized even more. So looking for us, we apply the same principle, real solutions to real problems, doing things in a different way to solve pain points and that are sustainable.
Thank you, thank you. Samantha, would you have any comments on that aspect?
I think I'm surprised at the view that the heyday of venture capital has passed. I think maybe I feel this in crypto is like a microcosm, but it feels like what's passed is kind of easy, permissionless innovation. So like people creating in one day, like the, I don't know, pet delivery app or something. Like that's easy stuff that reshuffles discretionary spend in the economy. It's easy, you can do it in a day. It's cheap in a way to start because of other things. But I guess to your point, Edward, earlier, like there are real economic challenges that face us now in this economy where productivity has stagnated. Like you need things to shake up healthcare and education and infrastructure. And the people who do that are going to come with real domain expertise.
Right.
And they're going to do that with VC funding. So I think it seems like a pretty exciting time to actually prove that this can make the world better.
Thank you. Edward, there's been some comment that, following the disasters we've seen at FTX and other situations where really major well-known houses have had very little focus on governance and due diligence. Do you see that as a trend that people are really focusing on this aspect now in a way they weren't before?
I certainly hope so. I mean, I think any investment process, whether it's credit or public or private or infra or whatever it is, it all needs structure and process and governance and oversight. So, clearly when there are periods of very easy money and returns being made very, very quickly, a lot of that discipline gets put to one side. Some guy turns up in a pair of swimming trunks and flip-flops at the Canadian pension plans and asks for some money for FTX, and no due diligence was done, and look where we are. I think we need to be careful not to confuse lack of governance in some of the hotter parts of recent years with the underlying trends that Zaid was talking about. Of course we need all this governance and so on, but again, coming back to this idea that we can possibly consider venture as the R&D of society, and if that R&D of society is 3 or 4% of GDP, let me ask how many people in this room have got a 3 or 4% allocation to venture capital? A few. One lady in the left-hand corner puts up her hand. I don't think that's going to be enough. So I think we need to be careful not to confuse these extremely eye-catching headlines that the press will have us look at with what's going on underneath, which isn't changing.
I was moderating a panel on crypto just 2 weeks after FTX, and I mean, it was extraordinary that Sequoia and Temasek and SoftBank weren't even on the board. I mean, they'd done very little homework. In fact, it was the hype factor. But as you say, one shouldn't necessarily generalize from that particular situation.
Look, I think, every time you get booms, I mean, there's enough of us in this room who look like they've been through lots of different cycles, and every time you get these booms, we had it with Enron. Was that a power thing, or was that just bad company that was fraudulent? It happens.
Sure.
And we've seen it time and time again, and it will happen again. So, I think there are very simple lessons to be learned about your discipline and your due diligence and your governance and structuring your process and having the ability to sit back, even when it's white hot, and say, actually, do you know what, this one's not for me. Hard to do, but an important discipline.
Right.
Yeah, but I'd say there's a difference between Enron, where there was fraud and, misguiding people, and here where people just didn't do their diligence, and they're supposed to be the top and best in the business. That's what grabs the headlines and causes pressure and negative headlines for the whole industry.
Right. Zaid, I'd like to ask you another question about performance. There was a recent Kaufman Foundation report that overall, the VC sector performance is not particularly good. It would have been better in public markets, apart from a few stellar institutions at the top of the tree, as it were. The average fund loses money or breaks even. Could you give us a few comments on your view on return in VC world?
I'd say don't look at the short term, because every time you look at the short term, then people go into short-term asset allocation away from a certain sector into another one, and then that flips. On the longer term, PE, and VC is a big part of that, has outperformed public markets. And that's why you've seen a major, wave of money moving from public to private over the last 20, 25 years. And I think, going forward, again, you've had this period, yes, now, it's, you said doesn't look good, that's an understatement. It's looked disastrous last year, but that means you've got great opportunities ahead of you.
Right.
Yeah,
Samantha,
I
please.
mean, I guess for some Friday afternoon levity, this is why I've struggled with being a VC investor, because it's hard to do anything where you don't really know if you're any good. Because, like, you know, if people say generally that in investing it's easy to conflate skill and luck, then it sure as hell is in VC, right? I think there's some stat that, like, in the 90s, the top decile of Silicon Valley funds shared one thing, and it was like that they were in Google up to pre-IPO round. That was it. And then in the 2000s, it was the exact same thing for Facebook. And you know, maybe you could say there's some mediating variables, like you got in those because you made other bets that were viewed well by the market, or your peers rate you highly. But the point is, it really boils down to a few winners, and that doesn't feel like much of a craft, right? That feels like luck. So I guess to that, one thing I'm hearing more is, you know, if it is hard to decipher where someone really has skill here and how they are sourcing these investments and what is the trick, right? We're hearing a lot of, like, what's the process that's repeatable for you from LPs? So where they're saying, you know, all these VCs say that they add value or that they can shape outcomes. Can you point to something that you can do time and time again that exemplifies that? So not one guy who you were on his board and he says you were a great advisor, but something that's a real technical advantage, or I don't know, a real marketing expertise that you bring to portfolio companies. So I think there's going to be more of that that's going to winnow the field. It's like, why do you have a right to win time and time again?
Right. Ziad, any comments on that, Zaid?
I mean, I agree with Samantha fully. I mean, one thing when I talk to any fund is, what differentiates you guys? The returns you're showing me, the breakdown. I mean, I've seen 10 others like you. Why should I go and invest in you? And we've actually gone with funds that have, you know, a great operating platform where they can bring a lot of advisors to help very smart people who have no commercial idea of how to monetize those great ideas. And bringing that whole infrastructure can help actually create value.
I have a slightly different perspective on this. So in public markets, top quartile performers tend to change year in, year out, depending on whichever style or factor may or may not have been working in the market for that year. So growth, momentum, value, and so on and so forth. You know, one year the top 5 hedge funds will be these guys. The next year they won't be there because their style's different and they won't be good enough to be able to read those different signals. In venture, the top quartile investors tend to be the same year in, year out, because once they acquire the reputation for being the destination that founders want to go to and the partners that founders want to work with to deliver the best outcomes, they attract the best talent. It becomes very, very sticky. Sequoia, a good example.
Right.
Sorry, I need to comment a couple of things on that. Not that what you're saying isn't correct, but sometimes you have to get under the hood to see what's happening. So, for example, being on a board of a company with one of the major VC funds, and I saw how they behaved on the board, I'll never invest in that fund. So that was more like luck than them actually, they were actually destroying value rather than adding value. And going back to Sequoia, yes, Sequoia's a big name, but, you know, I'm totally against the policy they adopted a year ago, where they want to hold on to public market stock and, you know, enjoy the value there. They're just looking to maximize their carry, and they don't have the public market skills to manage that within the context of a portfolio, so I think it's damaging to LPs.
Right. Could I just raise a point about valuations? I mean, we've seen interest rates obviously increasing substantially in the last 9 months plus. This does affect valuations. I had the same conversation on a private equity panel. And private equity values, and I guess venture capital is part of private equity, have not, on the whole, been adjusted in any way. The answer was, well, these are long-term investments. We don't need to adjust them. Edward, would you have any comment on that? How do you calculate your enterprise value, for instance, these days?
And so I worked at an American bank for a number of years, and we would mark our book every single day at 5 o'clock Hong Kong time globally. Right. Because that's the right way that we felt. And we would see the public accounts of other businesses that you would see them marking their books once a quarter, once every 4 months, once every 5 months, which didn't feel prudent or conservative or well-governed, as you were discussing earlier, to us. And so I think the same logic has to apply to to private equity as well. And so, if people haven't taken their medicine or they haven't taken their marks, I mean, it's pretty axiomatic that if something is at a 75% drawdown in public markets as a very public reference, that there's going to be some type of a markdown in the private markets, of course.
Yes, yes.
So I think the only sensible conservative thing, which you can see some managers do, is to make those adjustments and ensure that there's enough liquidity to see them through.
Right. Thank you. Samantha, any comments on valuations? Have you changed your approach?
Yeah, I mean, I spent a lot of the last few months trying to raise liquidity by doing secondary sales out of a venture book. Well, not this company, but my last one. And I think that's exactly right. It's not really magic to value, at least maybe not earliest stage, but there are public comps. And that's exactly what we did, and that's what was accepted by auditors and by our shareholders. And by companies themselves, right? We would go to them to negotiate these secondary sales, and they would say, hey, I don't know if it's a Chainalysis, they would say, look at public SaaS. It's about 70% down. You're also going to get a bit of a timing penalty, right? Because we haven't gotten into that, which is these are long-dated instruments. You face issues if you're looking for an exit in your portfolio because you're going to take a timing penalty, and so it's probably going to be a slightly even larger discount on those.
Right. Yeah. Fantastic. Edward, I think that at Antler you've got an incredible geographic spread of your business. It's very, very impressive. Could you tell us a little bit about where you feel the opportunities are coming from in today's world, geographically and perhaps sector-wise?
Yeah, sure. I mean, our fundamental tenet is that talent is global and it's talent's everywhere, and that you're as likely to find a great founder in a slum in Bombay as you are from Harvard University, is our view.
Right.
One of our great investors did a discussion like this, where he shared the story that Stanford University opened up their AI course online to anybody in the world who wanted to participate. And the top AI grad at Stanford placed 400, making the point that talent is everywhere. They just don't necessarily get the opportunity to go to Stanford University. It's a bit like saying, do you think the best athletes in the world are from California? Of course they're not. They're everywhere. They just have different opportunities. So our fundamental tenet is that talent is multifaceted. It comes from all backgrounds and all shapes and sizes. The opportunities are very, very different, so it's very unequally served. And so if you look in the US, where there's such a tremendous heritage and tradition and embedded infrastructure of innovation and startups and building and scaling and growing, is very different from a company like Japan, where you would think NEC, Sharp, Panasonic, Toshiba, Nintendo, these awesome consumer electronics companies, why haven't there been more big tech outcomes there? And it's because this is a very, very different investor mindset. It's very, very conservative, which Kishida is now kind of trying to change. If you go to Riyadh, for example, I don't know how many people have been there recently, but the on-the-ground change is pretty stunning, certainly compared to what the Western press would have us all believe. And they can't get enough of this type of activity because they recognize that they're a young, very rapidly growing, dynamic population that wants to innovate and wants to de-emphasize its dependency on fossil fuels, amongst other things. And so where you see these governments and countries really, really get behind that base layer, this 3-4% R&D of GDP, which I keep talking about, you see amazing outcomes which really enable that distribution of talent. Right. You can look at many other countries, lots of which are in Europe, where they just don't have that sense. I do a straw poll on how many people in this room have an allocation to this type of stuff. Didn't seem like very many. And as a consequence, that talent simply can't get on in the same way. So I think it's, talent's everywhere, but it's served in very different ways according to the attitudes of the incumbent countries.
Right, because you've got a fantastic geographic exposure at Antler. I think it's most impressive.
In 23 countries, yeah.
Yeah. Zaid, any comments on that, on your geographic and sector preference?
I mean, we don't have any preferences because we like to maintain an agnostic and opportunistic approach to investing, and that applies to all asset classes because, as Edward said, talent is global. Then you have to look at other factors like how big the markets are, opportunities for liquidity, how difficult or how easy the exits are. So, I would still, in terms of VC, sway more towards, number one, the US, number two, Europe, where they're getting more and more unicorns over the last decades, and the whole ecosystem has improved incredibly. I do look at emerging markets, and we got direct investment in India, for example, but I'm very cognizant of, emerging and then frontier markets. Even if a company's fantastic, the exit opportunities are far more difficult.
Right. Thank you.
So, of course, one day all public and private assets will trade on the blockchain. There'll be no difference between public and private.
Samantha, I think that you've recently produced a very interesting paper at your company. You were looking at geographic areas of interest, and particularly suggesting that Europe might be developing as a major center to rival even Silicon Valley. And you were also looking at the type of things that your investors are looking at, not just the initial phase, but how you manage to mentor companies during the process.
Yeah, so we published a report recently that was on VC funding trends in Europe, VC crypto funding. And one thing we found was Europe has the largest amount of VC-backed crypto startups. It lags in scaled companies. So, on the one hand, that could be what Edward said, which is just there might be something endemic here, right? That it's just consistently harder for a company that starts here to scale and to reach unicorn status. Or it could just be that they're earlier, right? That this funding has picked up in the last couple of years, that the kind of companies that put for crypto unicorns on the map in the US, they were largely exchanges, like big centralized companies that needed things like bank connections and big marketing budgets, and that the next wave might be companies that Europe's better suited to. So that could be more technically, like in crypto, we'd call this kind of infrastructure layer, or more protocol stuff, where it can be more of a digitally native team. So that's what we're seeing in crypto, is a move that makes us encouraged here, that we think the opportunity set is really exciting. And that there's a lot of early stage opportunities. And I guess, the other tailwind for that is just the regulatory situation. So obviously this is, again, probably more unique to crypto than other areas of VC. But we have founders in the US that are moving to Europe, where they're nervous about, they don't see any regulatory clarity, certainty on the horizon, and they're really scared of operating in that kind of environment, especially if they're going to launch a token. So we see them moving here, and we see them starting companies here.
Thank you. Edward, I'd like to ask you one question, if I may. Crowdfunding. This is at a pretty retail level right now, but we're looking at, and have done all during yesterday and today, game-changing matters such as artificial intelligence. So do you see crowdfunding becoming a serious challenge?
I don't really know very much about crowdfunding. It seems to me pretty dangerous that you're letting non-professional investors invest in companies where they don't really have much access to due diligence and so on and so forth. So I'm not sure that's going to end that well. I think if you're investing in early stage companies, you need an enormous amount of diversification. I mean, statistically, it's been written about all over. And I wouldn't really be that confident in the ability of a doctor or dentist or nurse or whoever it may be who's going on a crowdfunding website to build a portfolio of 200 companies. I just think that's a very good idea.
Right. Thank you. Well, we're coming to an end of our allocated time. Zaid, I'd just like to ask you one question. Have you seen any changes in the sources of finance that you're seeking money from post-COVID and in this new high interest rate environment?
I would say the sources are still there, but the allocations have changed. And, unlike what I said earlier, people do react to the short term. So I've seen allocations to VC cut, and I've seen allocations within VC, as I mentioned, move from the growth to the early stage. There's been a significant move in that direction.
Thank you.
If I may, just very quickly, I very much agree with this. We see this every time. You get a downturn, people cut. You get an upturn, people over-allocate. It happens counter-cyclically the whole time. And we don't know where these winners are going to come from any more than we knew that Airbnb was going to be a thing, or that Ethereum was going to be a thing, or that ChatGPT or generative AI was going to. You don't know. And the only logical way to do it is just to allocate in small amounts every single year in a disciplined, structured fashion. Then you won't get all the bad vintages, all the good vintages. You can't time this stuff.
Right.
You either have a strategy or you don't. And actually on the source of funding, I think there's a very simple answer without being excessively political, which is governments need to get behind this.
Right.
I'm pretty sure that the NAV of most people in this room will move 5% a year anyway, either because of interest rate duration exposure or currency exposure. I know that's mine does. Why wouldn't you allocate the 4 or 5% of GDP to this asset class? If you lose the whole lot, which you have to be a chronically bad selector of managers, you're back to where you were last year. And if you get it right, you can make multiples of. I mean, we're looking for those payoffs all day long, and it's not exactly as if there's an embarrassment of alternatives at the moment with bonds guaranteed to return negative real yields for the next 7 years. I mean, I just think it's sober, balanced thinking, and governments can do so much to get behind a laptop in the hand of every child on the age of 12, rural broadband, healthcare, the education system, which needs a dramatic overhaul. Very simple.
Thanks.
Would you cut
Samantha.
your fee structures to get government funding in?
What I would?
I mean, I'd imagine if governments are coming in, they're not. They might be a little sensitive to some 2 and 20s. So.
Well, I mean, it doesn't change the necessary, the need for the outcome, I don't think.
Actually, to answer that, because there's plenty of government agencies like EIF, the BBB, the fund startups, they really don't care about the fees. They even take on less carry, or they would take more to allow other investors to benefit.
Thank you. We've actually officially run out of time. Any questions from our audience, for our experienced panel?
Thank you for joining us on a Friday afternoon in grey light.
Well, that's... oh, here we are. Right, one question.
Well, actually, I have 2 questions. One is, what are your thoughts on the future of impact investing? And the second question is, how is new models in the VC world emerging? Like, for example, decentralized autonomous organizations, DAOs, for example. Any thoughts on that?
Any?
I didn't get the second question.
The second,
The second question is about DAOs,
It's very
decentralized
blurred.
autonomous organizations where VCs are creating DAOs.
Without the mic. Just tell us without the mic,
Yeah,
loud voice.
excuse me,
That's
feedback.
better. Yeah.
Yes.
Yeah.
Better.
Second question is about DAOs, or decentralized autonomous organizations, where I think this few VCs setting up investment DAOs. So what are your thoughts on how the VC world is moving towards DAOs?
Decentralized VC.
Yeah, decentralized autonomous organizations.
Edward, would you like? Well, Samantha, go ahead. Yeah.
Okay, I need to buy myself time by asking what a DAO is. No. I think I thought of this when Edward was speaking before on crowdfunding, and he was saying, which made sense. Was saying like, okay, how can the average retail investor really know about a company to make this to understand the risk, to understand like a fundamental analysis, and that's why we have investor protection rules. And I think where I kind of shook a little at that moment was I thought, it's not all or nothing, right? They don't need to put 30% of their portfolio into... Okay, sorry. They don't need to put the family mortgage into a bunch of startups that they don't fully understand the cash flows. And then I thought, there's a middle ground, and that's, I think, where crypto and DAOs and other ways to bootstrap networks that people are part of comes in, which is there a world where people want to invest in things that they're part of early? So, and if I don't get too complicated with this in the world of like NFTs and global networks and societies, and I just say, hey, there's something down the street, I'm going to be one of its first customers. Yeah, there's one thing that's like kind of receivable financing. Maybe that's one way in the past. In age of old, I might have taken a bet on something. I say, if I'm going to come in early, let me pay the same rate forever, but own a stake. I think all of this is just being modernized with some of these structures, which is, if I'm going to bootstrap a network, it's not going to IPO on day one, so I can't have equity in a fledgling business. If I'm going to be part of setting it up, how do I get some sort of ownership? And can I make something that might have looked like crowdfunding? So I'm contributing, I'm bringing friends in, I'm doing these behaviors that they want to reward me for. Refer a friend, play the game, this, that. can I own something of it? And I think that's where we'll see different ownership models like DAOs.
To answer your first question about impact investing, I think it's very important. I think more and more people are realizing it's a myth that impact investing has to come at the expense of returns. Because if it does, then it's not sustainable, therefore it's not really going to help you going forward. We look at that, and we've done a few investments in that space. It's all part of the analysis. I mean, for example, we've invested in a wide range of things, from improved women's health in a direct company in San Francisco, through to a fund that focuses on plant-based foods.
I think venture is impact, right? You're enabling young people, you're creating jobs, or enabling people to work on solutions to personal experiences where they've just had poor experiences. A lot of the businesses that are being built is because somebody's just had a poor experience because their grandmother was poorly cared for, or because they weren't able to get a bank account, or because they weren't able to get education. These are impactful, real things. And so if you're enabling and facilitating solutions to education, healthcare, financial services, climate change, the existential whopper, that's impactful.
Thank you. Important question. Any more? One over here.
Yeah, hello. The question goes for three of you. Do you guys look into investing in Africa? In which area and which industry are you guys looking into investing, if you want to invest in Africa?
So we have a pair of ladies operating in Nairobi. Super exciting business, very, very vibrant market, very vibrant economy. We're industry agnostic. We're just looking to help and enable really, really talented people. It just so happens that 40 to 50% of our portfolio in East Africa is fintech related. I suspect probably reflecting the inadequacy of the existing infrastructure and financial services. And similarly to in Nigeria. So we're very excited about that part of the market. We see it as a very rapidly growing, dominating force, and they're driven by these massive population trends. So yeah, we do.
Thank you.
We haven't had the opportunity to invest in Africa yet. We've seen some, but not enough. And I'll be honest, our network there is not very strong. However, we're about to onboard a couple of clients from Africa, and that should hopefully give us a doorway to understanding the whole infrastructure and ecosystem better, and give us some opportunities.
Samantha, have you any comments on that?
The lady over there, I think it was.
Got another question? Yeah. I guess you're very European.
Hi, just a question about the portfolio companies that are looking to leave the U.S. Is it that they're completely abandoning the U.S. market, so that because the way it works in the U.S. is no matter where you are, if you access the U.S. market, you're still caught. So what is the rationale? Is it just the lack of clear public policy, and they're not looking to have any clients in the U.S., or is it that they're not aware that they still have to comply, even if they leave the U.S.? So what is driving it? And then secondly, given SVB, the lack of, SVB in the U.S., what banks are your portfolio companies looking to access nowadays?
Yeah, so perhaps you're
Very
right.
quickly, we're getting out of time, so just a quick, no, please go ahead.
Yeah, perhaps there's naivete on how far the hand of the U.S. government stretches, but I think what I was referring to was these are often founders that they're setting up like a foundation or an entity. They're figuring out how they're going to launch their protocol, how they're going to interact with developers globally, token holders. This is kind of a fact of crypto that they have this weird large web of stakeholders. So as they're setting that up, they're in the US and they are thinking, it feels like a minefield here because I can't talk to someone who can say this is what it's going to be in 3 months or 6 months. I'd rather go somewhere where someone can, right? And so if I go to Switzerland and they tell me, look, there's a pretty clear framework and it feels pretty static, it feels consistent, they'd rather just start that process of setting up shop there. We have seen projects like that have gotten to the point of launching exclude US investors. and yeah, take measures to avoid like all aspects of material presence in the US, but I was more referring to even at the earliest stages. So, and it played into that report because we'll see it pan out at the stage at which they're seeking seed or Series A funding. They've already made that move.
Well, look, thank you very much indeed. I think we could have asked a number of very interesting questions further, had a further discussion, but thank you very much. Could we give our panel a big hand, please? Thank you.